Welcome to the Deep Dive, your regular source for actionable insights, especially from the latest earnings calls. Today, we're diving into eGain Corp, ticker eGain, specifically their fiscal fourth quarter and full year 2025 results. And this isn't just, another set of numbers. It feels like a story unfolding. The company's signaling a pretty significant strategic pivot towards AI. Management sounds really enthusiastic about where they're heading, but, well, investors, they're watching, looking for that sustained execution. So our mission today, let's unpack these results, explore this bold new direction, and try to understand what it all means for the market and, of course, for you listening. Okay, so let's start with the headline numbers for eGain's Q4 fiscal 25. Some really critical positive shifts here, I think. Non-GAAP EPS came in at 9 cents. That's earnings per share, excluding some items, gives you a clearer picture of core profit, and that comfortably beat the consensus estimates. Revenue hit $23.2 million. Okay, a modest beat, but here's the kicker and why it's actually pretty significant. It was a 3% year-over-year increase.
Now, that might not sound like a huge jump, but it's the first time they've reported year-over-year revenue growth in, 8 quarters?
It's exactly 8 quarters. That 3% isn't just a small number. It's tangible proof, maybe the first real sign after 2 years, that this big AI pivot might actually be working. It kind of directly pushes back against that show-me skepticism from investors we've seen.
Right.
And beyond the top line, their margins looked strong too. Total gross margin hit 73%. The SaaS gross margin, so just the software as a service part, even higher at 80%. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, basically operational profitability, was $4.5 million. That's a pretty impressive 19% margin.
Solid numbers.
Yeah, and the balance sheet looks good too. $62.9 million in cash and equivalents. So put it all together, it paints, a very positive picture, a foundation maybe for future growth. Suggests those strategic bets are starting to pay off.
That's a perfect segue, actually, because it brings us right to the core of this story.
Yeah.
That strategic pivot. What's really fascinating here isn't just that they're shifting, but how. It seems like a complete deliberate move towards AI knowledge solutions. We see lots of companies jumping on the AI train, but eGain's CEO seems to have a very specific idea about where the real value is. Can you elaborate on that? What makes their approach stand out?
Absolutely. Look, they're not just, sprinkling AI dust on things. They're going all in on what they call trusted knowledge.
Yeah.
Their argument is that this trusted knowledge is absolutely critical if you actually want to get real ROI, return on investment, from AI.
Okay.
Their view, which is pretty bold but makes sense, is that without curated, reliable knowledge, generative AI is basically, and this is their phrase, stuck in the rut of garbage in, garbage out. They even pointed to a recent MIT study. Apparently, it found that something like 95% of AI investments just aren't showing significant returns. So eGain believes their approach, focusing on this trusted knowledge, fixes that fundamental problem that seems to be hitting a lot of enterprise AI projects. It's less about the flashiest model, more about reliability.
Yeah, and they seem to be backing this up with product innovation too, right? They launched new AI agent products.
They did, specifically for customer self-service back in March 2025, and then for contact centers more recently in June 2025. And what's interesting is they're apparently seeing strong early interest, especially from CX leaders, customer experience folks who've maybe struggled before with agent assist tools from other vendors.
So it sounds like the market is maybe starting to see that need for the trustworthy foundation, especially if other attempts fell short.
It seems that way. And look, this isn't just about adding new stuff. It's a whole portfolio management thing. As part of this AI focus, they're actively sunsetting their older legacy messaging products. That's happening through fiscal 26.
Sunsetting.
Okay, that sounds significant.
It is. And it does come with a near-term cost. They estimate about a $4.7 million hit to ARR, that's annual recurring revenue, the predictable subscription money. That impact starts Q2 FY26 and goes to zero by Q1 FY27. But crucially, it's a deliberate choice. They're shifting resources to higher growth, higher margin areas, accepting that short-term pain for, they hope, long-term gain.
Makes sense.
And to support this, R&D spending was up 15% year over year in FY25. They're planning another modest 6% increase for FY26, investing specifically to extend their lead in this AI infrastructure space.
Okay, sunsetting products for a $4.7 million ARR headwind, that is definitely a bold move. What's the potential downside there, though, beyond just losing that revenue immediately? I mean, are they risking upsetting some existing customers who might still use those tools or making themselves vulnerable somehow? Or is the upside from just purely focusing on AI knowledge really that big? That's the key question, isn't it? And yeah, there's always a risk when you phase things out. Some customers might look elsewhere if they rely heavily on those old tools. But eGain's bet clearly is on the overwhelming market need for reliable AI. The opportunity cost of not going all in on AI knowledge, especially given what that MIT study suggested about failed AI projects, is probably seen as much, much greater. They're trying to position themselves to grab a big piece of a growing market by basically cutting loose the distractions, focusing R&D, sales, everything on the future.
And speaking of validation, this is where it gets really interesting. The company highlighted some major new wins, particularly that huge deal in Q4 with the U.S. mega bank. We now know it's JPMorgan Chase, and it's their third win inside JPMC. With the AI Knowledge Hub now serving all bank employees in the U.S. Chase business, that sounds massive. But what does one big client really mean for the whole strategy?
Well, this JPMC deal isn't just, a big sale. It's framed as a deep strategic collaboration. Management even called it an unfair advantage.
Unfair advantage? How so?
So, to strengthen the partnership, eGain issued warrants to JPMC back in August. That gives JPMC the right to buy eGain shares later. And importantly, JPMC agreed to nominate a senior exec to join eGain's board as an observer.
Oh.
What that really means is JPMC, a tech-savvy financial giant, is essentially giving eGain a live, high-stakes R&D lab. They get direct feedback, validation, help refining the product for a really demanding environment. That kind of deep insight from a sophisticated user like JPMC, that's invaluable. It's not just selling, it's co-developing. That's the unfair advantage they're talking about, especially in finance.
And it wasn't just JPMC, right? There were other wins showing broader appeal, too.
Correct. They mentioned new clients like a large nonprofit healthcare network in New Jersey, 18 hospitals, 36,000 staff, huge scale, and one of the nation's biggest credit unions, both using the solution for unified knowledge management. Plus, an existing client, a global leader in workforce services, is deploying the new AI agent for contact centers. They expect it to help with over 15 million phone calls a year. So yeah, these aren't small test cases. There's significant deployments across different critical sectors, suggesting that trusted knowledge message is resonating widely. And, underpinning all this strategic stuff are some key operational improvements. These aren't just about saving money. They're about building the capacity to actually support this pivot and grow margins.
Like what specifically?
Well, for one, they finished migrating all their clients to their new cloud platform architecture in Q4. That leads to sustainable improvements in COGS cost of goods sold. Basically, it costs them less to deliver the service now. And they're using AI themselves internally, streamlining their own operations, improving productivity, quality.
Eating their own dog food, so to speak.
Exactly. For example, they mentioned automating customer onboarding documents with their own AI. Cut the time by nearly 30%, frees up engineers, those savings, partly reinvested in R&D, partly helping the bottom line. And you see the momentum in their core metrics, too. AI Knowledge ARR grew 25% year over year in FY25. That's strong. And for those knowledge customers, the LTM last 12 months, dollar-based SaaS net retention was 115%.
Okay, break that down. 115% net retention means?
It means, on average, their existing knowledge customers spent 15% more with eGain this past year than they did the year before. So they're sticking around and expanding their usage. That's a really powerful sign of satisfaction and product value.
Okay, so pulling back again. What does this signal to shareholders beyond the operational results? Well, the company's confidence seems pretty high, judging by their capital allocation. The board approved another $20 million for stock buybacks. That brings the total authorization up to $60 million. And they actually bought back $3.8 million worth of stock just in Q4.
Yeah, that's a substantial increase to the buyback program. It definitely signals strong management belief that the stock is potentially undervalued and that they see a big opportunity ahead in this AI knowledge market. It's putting money behind the talk.
All right, let's look ahead then. Management laid out guidance for fiscal year 2026. Sounded pretty bullish. They're projecting total revenue between $90.5 million and $92.0 million, signaling, importantly, a full return to overall revenue growth for the year. But, given those 8 quarters of decline we talked about, are these targets ambitious enough? Or does the market still need convincing they can hit them consistently?
Oh, they're definitely ambitious. And you're right, investors will be watching like hawks. Execution is key now. Profitability targets are also pretty robust. Non-GAAP EPS guided between 30 and 36 cents. Adjusted EBITDA margin expected at 11% to 13%. That implies a 40% year-over-year increase.
Significant jump.
Yeah. And the CFO specifically called out aiming for gross margin expansion to 74-75% for FY26. That's up from 71% in FY25. driven by, selling more of the higher margin SaaS stuff and getting more efficient with AI automation. AI Knowledge ARR specifically, targeted to grow by roughly 20% or maybe even more.
Okay.
For Q1 FY26, the first quarter, they expect revenue between $23.0 and $23.5 million and non-GAAP EPS between 11 and 14 cents. One small technical point, but important for understanding the numbers. There's an estimated $1.4 million non-cash expense related to those JPMC warrants factored into both the Q1 and full year guidance.
Non-cash, meaning?
Meaning it's an accounting charge reflecting the potential future value of shares given to JPMC. It hits the reported profit number, but it's not actual cash leaving the company's bank account right now. So it impacts EPS, but not cash flow directly.
That raises the big question then. What's the broader investor context here? How did the market actually react to all this?
Well, right after the earnings call, the stock reaction was positive but modest, up about 2.8% in after-hours trading.
Only 2.8% after all that positive news in the JPMC deal.
Exactly. And while management's tone was definitely bullish and the numbers were solid beats, that fairly muted reaction suggests investors are still very much in show-me mode. They've heard the pivot story. They see the JPMC win as a positive sign, absolutely. But the market seems to want concrete proof of sustained growth. Consistent execution against those ambitious FY26 targets quarter after quarter. That's what they're waiting for. And of course, this isn't happening in isolation. There are helpful industry tailwinds. The software sector overall is doing well, outperforming the broader market. And budgets for AI and knowledge automation are definitely growing. So that provides a sort of favorable backdrop for eGain's strategy.
But in that crowded AI space, what makes eGain stand out? What's their competitive edge, supposedly?
Well, one thing they highlighted was a strong conversion rate from AI pilots to paid deals. They claim about 2 out of 3 pilots convert.
Okay, that's pretty good.
Yeah, it suggests the solution is effective and differentiating itself. It backs up their whole trusted knowledge argument. AI is only as good as the knowledge it has. Their success rate implies customers are seeing how eGain might avoid that garbage in, garbage out issue that maybe tripped up other AI tools they tried. They specifically mentioned seeing success where other agent assist solutions had failed.
Interesting. And what about future big deals? Anything like JPMC in the pipeline?
They didn't signal another JPMC-sized deal immediately, no, but they did say they have a good set of 7-figure opportunities. And interestingly, these deals are apparently starting more often in the contact center now, and then expanding out to other employees, which naturally leads to larger overall deal sizes.
So for investors or anyone tracking this, what are the key things to watch, the upcoming catalysts that might, move the needle?
Okay, several things. First and foremost, can eGain actually deliver on those FY26 targets, especially the AI Knowledge ARR growth and the gross margin expansion? Execution is number one. Second, watching how that big JPMC win translates. Does it lead to broader traction, maybe more wins in finance or other large enterprises? That validation needs to spread.
Right.
Third, any more share buybacks under that expanded $60 million program. That would signal continued confidence. And then there are specific events. Keep an eye on the eGain Solve customer event and investor analyst day. That's October 14-15 in Chicago. Expect product news, demos, customer stories there. And they'll also be meeting investors at the Roth conference on November 19th in New York. So those events could definitely provide important updates and maybe shift sentiment.
Okay, perfect timing to switch gears slightly. Let's do our This Is Not Financial Advice segment, where we pitch a, let's say, outrageous but plausible trade idea, just for fun. Like a hedge fund analyst might brainstorm. Remember, purely entertainment. Spark some thinking. My first idea, the AI infrastructure laggard arbitrage. The pitch, go long eGain bet on its stock going up. And at the same time, short a basket of those really hyped up generative AI stocks, maybe the pure plays or the big enterprise solutions that don't have that proven trusted knowledge layer.
Okay, I like it. And the outrageous rationale behind that really leans right into eGain's core argument, doesn't it? If the CEO's right, if 95% of AI projects are struggling because of garbage in, garbage out, then eGain isn't just another AI player. They're providing the essential plumbing, the picks and shovels for this whole revolution. Yeah. And that JPMC deal, especially with the warrants and board observer, it's like a major validation from a smart player. So the trade bets that the market has got it wrong. Yeah. It's chasing the flashy AI models, but ignoring the crucial infrastructure, the plumbing that makes them actually work reliably in an enterprise. eGain is the overlooked plumbing in this theory, and the trade anticipates a big market reevaluation, focusing back on that foundational layer.
Love it. Okay. Outrageous idea number 2. The sunsetting synergy catalyst call. For this one, maybe consider a long-dated, slightly out-of-the-money call option on eGain, let's say expiring after Q1 FY27 when that legacy revenue is fully gone. And maybe pair that with a short position in the legacy messaging sector itself if you can find a suitable ETF or maybe some individual companies there.
Okay. Playing on a different aspect of the strategy. So eGain is deliberately taking that short-term $4.7 million ARR hit by ditching the old messaging stuff, right? To focus purely on high-margin AI knowledge. The market sees the headwind now, probably views it negatively, but this trade bets the market is underestimating the positive synergy, the focus they gain by completely shedding those distractions.
Precisely.
So the bet is once those legacy products are fully off the books, maybe by Q1 FY27, the market will suddenly re-rate eGain, judge it purely on its high-growth, high-margin AI Knowledge ARR, and that could lead to a much higher valuation multiple. The call option captures that potential upside from the re-rating, while the short position is sort of a hedge against the declining legacy sector eGain is leaving behind. Again, purely hypothetical, entertainment purposes only.
Okay, so let's wrap this up. We've taken quite a deep dive into eGain's Q4 and fiscal 2025 results. We've seen, a solid beat on the numbers, this bold strategic pivot towards AI knowledge, the really critical validation from that JPMorgan Chase partnership, the expanded buyback program, and some ambitious guidance for fiscal 26.
Yeah, the narrative from eGain is crystal clear. They believe they've found and are delivering the foundational answer to AI's big ROI problem in the enterprise, that trusted knowledge piece. But as we discussed, the next few quarters are absolutely critical. With those investor events coming up too, we need to see if the broader market fully buys into the story, and crucially, if eGain can sustain that return to top-line growth. Execution is everything now.
And maybe a final thought for you listening. As you think about your own investments or maybe your own company's AI strategy, how critical do you think this concept of trusted knowledge really is for AI to succeed broadly? And is the market truly appreciating the value of that underlying infrastructure, the plumbing that powers it all? Or are we still maybe too captivated by the flashy front-end applications? Something to definitely mull over. As always, please remember, this is not financial advice. We strongly encourage you to do your own research, your own due diligence, and consider multiple viewpoints. Thanks for tuning into the deep dive. We always welcome your thoughts and questions.